Wondering what the best level of salary is for the 21-22 tax year? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And of course, one of the main topics that comes up a lot is how do I pay myself in the most efficient way? Now, by efficient, we just mean making sure that you're not paying more tax than you need through lack of knowledge. So we've done other videos on this. You can see, salary versus dividends. You can see there's one on director's basics. All these things help you get that knowledge that you need to know around different ways to pay yourself and some of the things you've got to take into account. And it's all based around making sure that just because you don't know the knowledge of roughly 22,000 pages plus company law, that you're not making any errors and paying more tax than you need to. So in this video, it's going to be a relatively short one. I just want to tell you about two kind of common levels of salary that you might see during this year. So before we get into it, if you like these type of videos, make sure to click the subscribe button below so you get notified whenever we release more just like it. So before we get any further along in the video, I've got two kind of things to say. One, if you're a sole trader, switch off, stop listening. This is not for you. It's for limited company owners. So generally small limited company owners that are the director and also the kind of the shareholders, the owners, and that's very normal setup. So this video is for you. And the second one is kind of a caveat / disclaimer to say, look, shock horror accountant's going to tell you that you need to seek professional advice. But what we're talking about in this video, you should just treat it like dude on the internet has told me some information, not this is specifically for me, because I don't know your situation. And actually there's so many variables that could change this, but I am going to tell you the two most kind of common levels that we're seeing in this particular tax year, so that, in a lot of circumstances, this is going to get you off to a great start. Now, I'm also going to make two big presumptions. I'm going to presume that actually what you're going to do is you're going to pay yourself dividends over and above the salary I'm going to tell you. So if you're going to take more than the salaried amount that we're going to discuss, so let's say you're going to take £3,000 a month, the salary levels we're going to talk about are going to be less than £3,000 a month, that extra is going to come out as dividend, and I'm going to presume you've got enough profits to pay those dividends. Now, the reason you want to do that, and other videos we've done will talk to you about this, is that let's just say an example where you're earning 40 grand a year in that company, you're going to pay tax around 18% if you get this kind of split overall, so taking into account the personal tax and the company tax, that combined as a total of that 40 grand would be about 18%. Which is a fantastically efficient rate. You might look to pay something like 29% if you were just putting it all through as salary. So, but in order to do that, you're going to need to be able to pay the rest out in dividends. So you're going to need relevant profits. So I'm going to presume that's the case and that your company's healthy. The other presumption I'm going to make is that this is your only income. So if you've got a side hustle and you've got an employed job, you're probably not going to want to do the salary, and there's plenty of videos on the channel explaining why that would be the case. So this is for people where this is kind of like your main deal and you've got profit. So they're the two main caveats. So let's talk then about what are the two different rates and the two most common rates. And there are anything in between. I mean, you nearly always will want to pay yourself a salary of at least £120 a week, so about £520 a month. And the reason that is that you get a tick in the box that says for your state pension, over the years that you're in your working life, you have to hit so many years, so many ticks in those boxes before you can get your full state pension. You not declaring any salary or not earning over around £6,300 in a year, in one job as well, will mean that you won't actually get that tick in the box. So a big piece of this salary is to make sure that that's the case. So that's generally, but the most kind of the two levels that you're going to see is one when you're actually a director and you've got no other employees. So quite often like a freelancer of a limited company, that kind of thing, you'd see this level. And that is somewhere around £737 a month. Now, as if you've watched any of my videos, and even in this one, I like to talk round numbers. So I like to kind of make it look round. I don't know why, it's just something that I've always done. So for me, I would be paying about £735 because it just feels like a better number to me. And okay, you're a few pound light on the tax efficiency, but I also think then if you make any errors with other income and things, you've maybe got a little bit of tax bracket left to play with. So that kind of level is good. And the reason that level is good is because you won't pay any national insurance. So your company won't have to pay any national insurance on your salary. You won't pay any national insurance on your salary, but it's over £520 a month, which means you'll get that tick in the box. There's this weird sweet spot that says, here, have your state pension year, but you haven't paid us any national insurance. And a lot of owners worry about that. They think, well, I'm not paying any, but that's completely normal. In that bracket, you're okay. Then usually at this stage, somebody says, well, what about my personal allowance? I know I can earn around £12,500 a year without actually paying any tax. So why can't I just do that? And the answer is, national insurance. What would happen is your company, especially if you were the sole director, would end up paying employers' national insurance at 13.8% on some of that money. You'd pay personal national insurance on some of that money at 12%. So it's not really ideal taking all those things into account. And also, there's this weird bit where you've got to pay over the tax every month. So there's a practical issue with that as well, which adds to it. Going back a few years ago, there used to be this cool thing that saved you a couple of £100 a month by, using what was called employment allowance, which we're going to talk about in a sec. And what was possible then to do is, save this extra couple of £100, but it was a pain because all the directors then had to make this small little payment to the Revenue and Customs each month for the national insurance. So sometimes tax efficiency is amazing, but there's also your time in having to log on the bank and do these things and make sure that you're there. So, but overall, generally you wouldn't do this and pay up to the kind of personal allowance unless you can claim employment allowance, because then that extra 13.8% national insurance is actually not going to be payable, and then you're racking that up against the extra salary that you might pay 12% national insurance on is going to be deductible in the company against your tax bill. So you're paying 12% personal national insurance, but your company's getting a tax deduction at 19%, so it kind of works out a little bit better for you. And to get this employment allowance, there's another video on it, but generally you have to be employing another person who is earning over that 737 type level. So generally if you've got like an admin person who's earning that money, or even another director potentially, as long as there's somebody else earning over that kind of level, you tend to qualify. But check the video out and I'll talk to you about the caveats and that. So, but if that's the case, then actually what you tend to do is you will tend to do a salary of around, it should be about £147. But again, using round numbers, you're probably looking at £1,040 a month in that particular scenario, where you have got that ability to claim employment allowance. So they're going to be the two kind of amounts. You're going to look at, if you're say a sole director, you're going to be looking at that sort of £735 level. But if you employ somebody else and you're having to pay their tax and national insurance, that's kind of a good feeling for the type of situation where this would occur. You're going to be looking at that 1045 level, and that will kind of maximise what you're doing. What I would say is there's not vast differences between them, but obviously we like to be as tax efficient as we could. So as long, if you did pick 735 and ideally it could have been 1045, you're not going to massively miss out, but it does really help with that tax efficiency. And again, there are lots of different options and different situations where you might move that around, but they're going to be the most common levels in a straight sort of simple scenario. So that's it. Hope you've enjoyed it. Check out the other videos on directors' salaries and dividends and things like that. There's a ton of them on the channel, and please do share this with anybody that you think needs to know this information, and we'll see you on the next one.